Welcome back to the Deep Dive. Today, we are stripping down the layers of a brand that for millions of parents isn't just a store, it's practically, a rite of passage.
It really is.
If you've had a child in India in the last decade, you know exactly who I'm talking about. FirstCry.
It's a name that carries a tremendous amount of weight, emotional weight.
It really does. I mean, just think about the name itself, FirstCry. It's so visceral. It evokes that exact moment of arrival. The chaos, the joy, the sheer, what on earth do I do now, panic of having a newborn.
And for a long, long time, the company itself seemed to be riding that exact same wave of unlimited potential.
Absolutely. It was the undisputed king of the nursery. If you needed something for a baby, you didn't think twice.
You just opened the app. It was a default action.
Exactly. But recently, that name has taken on a slightly different, maybe a darker meaning in the Indian stock market. It was this massive listing, a huge milestone. But the morning after feeling has been, well, let's just say it's been a bit of a hangover.
A hangover is putting it politely. If you look at the charts, it's been a really sobering reality check.
And that's what's so fascinating. We are looking at a company that is, by all accounts, a market leader. I mean, we're talking about a 16 to 17% share in the organized childcare market.
Which is huge.
It's massive. They have this incredible moat of over 1,000 physical stores across the country.
Yeah.
But despite all of that dominance, the stock is trading roughly 50% below its 52-week high.
And that disconnect, that's the key right there. The disconnect between the physical dominance you see in every mall and the pessimism you see on the stock ticker. That is exactly what we need to investigate today.
Yeah, why is the market punishing a leader? And that's the mission of this deep dive. We aren't just going to read through the quarterly numbers, though we have plenty of those to get through. We're looking at a fundamental clash of business models. We're seeing a war on multiple fronts.
It really is a siege. You have the what we're calling the invisible enemy of quick commerce, which is eating away at the daily essentials.
Right.
And then you have the visible enemy, the fashion giants, Zudio and Westside attacking the high-margin clothing business.
And then you layer on the internal drama executives leaving, massive employee costs that are just eating up revenue, and this kind of shimmering oasis in the desert.
They're Saudi Arabia operations.
Exactly. Which might be the only thing that can save the day. It's a crazy story.
It's a classic case of valuation versus value. The company was priced for absolute perfection, but the reality on the ground is it's messy. It's really messy.
Yeah, so let's unpack this. Is this just growing pains for a giant, or are we looking at a genuine structural crisis? Let's start with the elephant in the room, or maybe the baby in the room.
That's a nice one.
The India growth story. Because looking at the numbers, things seem to be slowing down. Seriously slowing down.
Or the lack thereof recently. The growth engine is definitely sputtering.
Right. So looking at the recent performance numbers from the sources, revenue grew roughly 10%, and GMV, that's gross merchandise value, was up about 12%. Now, I have to play devil's advocate here for a second.
Go on.
In a vacuum, double-digit growth sounds decent, right? Why is the market reacting like the sky is falling?
Context. Context is everything. You have to look at two things here. Inflation and valuation.
Okay.
First, inflation in India is hovering around, 5 to 6%. So if your revenue grows 10%, your real volume growth, the actual number of extra items you're selling, is actually quite thin.
So you're basically just treading water against inflation. You're not selling that much more stuff.
Exactly. You're just selling it at slightly higher prices, which makes the top line look better than it is. But the bigger issue, the real killer, is the valuation.
Oh.
When FirstCry listed, investors were paying a massive, massive premium. We're talking about a PE ratio, price to earnings, of over 160.
Let's just pause on that for a second because I want to make sure everyone grasps the magnitude of that number. A PE of 160 effectively means investors are paying 160 rupees today for every single rupee of profit the company makes.
Correct. And you only, and I mean only, pay that kind of multiple if you expect hypergrowth.
Right. You're not paying for today's profits. You're paying for the profits of 5 years from now.
Exactly. You expect the company to grow at 30%, 40%, maybe even 50% year over year. So when a company that's been priced for a Ferrari engine suddenly delivers, Corolla speeds of 10% growth,
the stock price has to crash. It's just gravity.
The math just doesn't support the price anymore. It's a painful recalibration.
It feels like the engine is sputtering. And there's this term I saw floating around in the analyst reports, degrowth. That is a scary word for any retailer.
It's terrifying.
It implies things aren't just slowing down, they are actively shrinking in certain areas. It's causing this.
It's a combination of macro headwinds and some very specific micro issues. On the macro side, we're seeing softness in discretionary spending across urban centers in India.
So people are just tightening their belts.
They are. But your point is valid. Babies still need clothes, right? You can't just stop buying for the kid. It's not like skipping a vacation.
No, of course not.
You can't stop, but you can trade down. Instead of buying the premium organic cotton onesie, you buy the standard one. Or maybe you delay the purchase. Instead of buying 5 outfits for the winter, you buy 3 and just, wash them more often. Little changes that add up.
Right, the small compromises.
But there was also a very specific operational hiccup that the sources mention regarding the GST, the goods and services tax.
Oh, right, the GST change in August. That seemed to cause some real problems. What exactly happened there?
This is a great example of just how sensitive the margins are in this business.
Yeah.
So there were some changes to the GST structure, specifically around how certain tax brackets were applied to clothing. This created a lot of confusion in the market.
For consumers.
For consumers, for retailers, everyone. And in retail, confusion is the enemy of conversion. When people are uncertain about the final price, they hesitate. They pause.
So they just don't click buy.
Exactly. So to keep customers buying during that period of uncertainty, FirstCry had to ramp up discounts significantly.
So they essentially bought that revenue growth by sacrificing their profit. They slashed prices just to keep the inventory moving.
Precisely. The reports say their gross margins dipped by about 30 basis points because of that.
And just to clarify for the listener, 30 basis points is 0.30%. Sounds tiny, but on billions of rupees of revenue.
It's a lot of profit. It's a huge number vanishing into thin air. And it tells us something very, very important about the consumer right now.
Which is?
They are incredibly price sensitive. If you don't offer a discount, they might not convert. They're waiting for the sale. But there's a bigger, slower moving threat looming that I think is even more fascinating than these quarterly blips.
The demographic ceiling.
Yes, the fertility rate.
I feel like we always hear that India is this young, booming population, the demographic dividend. We're the most populous nation on Earth. But the data is telling a much more nuanced story, isn't it?
It really is. While India as a whole has a high birth rate compared to, say, Europe, urban India is a different story.
And urban India is FirstCry's core market.
It is. The people with the smartphones, the credit cards, the disposable income. And in that segment, fertility rates are dropping. Families are getting smaller.
So instead of having 2 or 3 kids, urban couples are stopping at 1. Or maybe 2 max.
Exactly. And FirstCry completely dominates the 0 to 4 year age group. I think the source said they have a 25% market share online in that specific bracket.
Which is just incredible dominance. That's 1 in every 4 online baby purchases in the country.
It is a massive, massive share. But it's also a trap because a child stays in that 0 to 4 bracket for 4 years.
The math checks out.
And then they age out. And as the child grows into the 4 to 12 bracket, the specialists need just. It drops off a cliff.
Right. You don't need a specialized baby store for a 7-year-old's t-shirt. You can get that anywhere.
Anywhere. So FirstCry is on this constant, relentless treadmill. They have a leaky bucket. They need to acquire newborns constantly just to stay flat.
Not even to grow, just to replace the kids who are aging out.
Exactly, just to stay flat. And if the number of newborns in your core urban market starts to drop, that treadmill just gets faster and harder to run on.
That is the age trap. And investors are noticing they're pivoting from that old mantra of growth at all costs to show me the profit. And FirstCry is caught right in the middle of that transition.
Correct. The wider e-commerce sector in India is consolidating. The days of endless cash burn, where you spend 100 rupees to make 80 rupees just to get a customer, those days are over.
Gone.
Investors want unit economics that actually make sense. They want each sale to be profitable on its own merits without, relying on venture capital to subsidize it.
And that brings us perfectly to the second front of this war. And honestly, this is the one that I find the most threatening to their daily existence.
The diaper dilemma.
Quick commerce.
This is the disruption that, nobody really saw coming 3 years ago. Not at this scale.
Let's talk about this, because as a consumer, I get it. I totally get it. If I realize at 9 p.m. that I'm out of diapers and the baby is crying,
oh, that's the nightmare scenario.
I am not scheduling a delivery for 3 days from now. I need them in 10 minutes.
And that behavior shift has been seismic. We're talking about Blinkit, Zepto, Swiggy Instamart. They have completely fundamentally disrupted the top-up behavior.
The sources call this the top-of-funnel erosion. And I think this is such a critical insight for our listeners to understand. It's not just about losing the sale of one pack of diapers, is it?
No, and that's the danger. That is the existential threat. If it was just about diapers, FirstCry could probably live with it because diapers are famously low margin anyway. They don't make much money on them.
They're a loss leader, almost.
Almost. But think about the mechanics of a retail app. What gets you to open the app in the first place?
The need, the emergency. I ran out of wipes. I ran out of formula. The essential stuff.
Exactly. High-frequency essentials. You run out, you open the FirstCry app to buy those, and while you're there, you see a banner for a sale on cute dresses or a new educational toy, and you think, oh, that's nice, and you add it to the cart.
It's the impulse buy. It's the classic supermarket logic. You go in for milk and bread, you walk out with a chocolate bar, a magazine, and a bag of chips you didn't need.
That's it. The diapers are the milk. They're the bait that brings you into the store. But now parents are buying the milk on Zepto because it arrives in 10 minutes.
And if they don't open the FirstCry app for the diapers,
they never see the dress. They never see the toy. They never see the high-margin items that actually make the company money.
That is terrifying for their business model. It turns FirstCry from a weekly habit, something I check every few days, into a special occasion store.
Which significantly, drastically lowers the customer lifetime value, the LTV. If you aren't capturing those weekly visits, your relationship with the customer just weakens. You become the place they go once every 3 months for a birthday gift, not the place they rely on for daily survival.
Now, FirstCry isn't taking this lying down. They have a defense. I read in the transcripts that they are arguing about SKU stock-keeping units.
Ah, yes, the SKU argument.
They claim they have something like 101,000 KOUs in categories like diapers and toys, whereas Blinkit or Zepto carries less than 1,000.
That is their main argument. They're betting on the long tail. They're essentially saying, sure, Zepto has Pampers, but do they have the specific eco-friendly bamboo diaper in size 4 with the aloe vera lining?
And they also point out geography, right? Quick commerce is really only a phenomenon in the top 10 or 12 cities.
For now, yeah.
FirstCry is in 500-plus cities. So they're saying, sure, you might lose the guy in South Bombay or Indiranagar, but we still own the rest of India.
And that is true for now. It's a valid point on geography. But I would push back hard on the sex you argument.
How so?
Do you really need 100 different types of diapers at 10 p.m. at night?
Honestly, no. I just need the one that fits and doesn't leak. I am not browsing for variety when I'm in the middle of a crisis.
Exactly. Quick commerce commoditizes the essential. They don't need to offer 100 options. They just carry the top 5 bestsellers, the ones that 80% of parents buy. And for those parents in that moment of need, that's enough.
They're betting on good enough right now versus perfect in 3 days.
And good enough right now is winning. Blinkit already has roughly 46% market share in this quick delivery space. They are fundamentally retraining the consumer to expect speed over infinite variety for these essential categories.
So FirstCry is offering this massive library of options, but the customer just wants the headlines delivered instantly.
That's a great way to put it. And here's the financial kicker to all this. If the essential volume migrates away, FirstCry is left holding the inventory for all those 101,000 SKUs. Those obscure items sit in the warehouse longer. That hurts their working capital. It ties up cash.
Okay, so that's the commodity war. The daily essentials are under a massive attack. But FirstCry has always said, we aren't just a diaper seller, we're a brand. They have Baby Hug. They have their own fashion lines. Surely that protects them. If I want that specific cute dress, I can't get it on Blinkit.
And that brings us to Section 3, the fashion wars. And if you thought the diaper war was tough, this battlefield is getting absolutely bloody.
This is where we talk about the big guns. The real heavy hitters of Indian retail. Zudio, Westside, Reliance Trends.
These are giants, absolute giants, and they are attacking the one place FirstCry thought it was safe, its high-margin fashion business.
So let's look at the economics here, because this is critical. FirstCry relies heavily on its private label, Baby Hug, for its profits. The sources say the gross margins there are around 30 to 33%. That's healthy.
It's very healthy. In retail, fashion is where the money is. Diapers and wipes are low margin, clothes are high margin. That 30% margin is what pays for the free shipping, the marketing, the returns, everything. But now, enter Zudio.
Zudio is everywhere right now. My social media feed is just full of Zudio hauls. It seems like they opened a store on every single corner overnight.
Zudio is a phenomenon. It's not an exaggeration. They're part of Trent, which is the Tata Group. And their strategy is pure, unadulterated, aggressive value.
We are talking about price points that make you do a double take.
Yeah.
I mean, Zudio sells trendy fashion for kids anywhere from, what, 199 rupees to 999 rupees.
Compare that to FirstCry. Their range often starts at 300 rupees and goes up to 3,000 or even more.
That is a massive gap. We were talking 2 times, sometimes 3 times the price for a similar item.
It is. And remember the age trap we discussed earlier. A toddler outgrows a t-shirt in 3 months. Maybe 6 if you're lucky.
Right. It's practically disposable clothing at that age.
So as a parent, I'm standing there looking at a shirt. Do I spend 800 rupees on a shirt they will wear 10 times and then inevitably stain with spaghetti sauce? Or do I spend 199 rupees at Zudio for something that looks just as cute?
Especially in an inflationary environment where my rent and my food costs are up. It's a no-brainer for a lot of people.
It is. Parents are rational economic factors. They are trading down. Zudio's model is built on high velocity. They turn inventory incredibly fast. They focus on fresh, fashion new styles every single week.
So there's always something new to see.
Always. And they operate with razor-thin profit margins, maybe 8 to 10%, but they make it up on sheer unbelievable volume. They sell millions and millions of units.
And the scale is just intimidating. Reliance Trends has over 600 stores. Zudio has around 545. They are physically everywhere. If I'm already at the mall going to Zudio for myself, it's very easy to just grab a few things for the kids while I'm there.
Of course, it becomes part of the routine. But FirstCry has a defense here too, though, a very clever one. They claim they aren't selling fashion.
What are they selling then?
They're selling parenting science.
Parenting science. I like that term. It sounds very authoritative. What does it actually mean in practice?
It means they market safety. It's all about organic fabrics. No rash guarantees, solvent-free buttons. They are implicitly and sometimes explicitly telling parents, do you really want to put that cheap fabric from that other store on your newborn's sensitive skin?
Ah, the guilt trip, the fear factor.
Yeah.
It's very effective on new parents.
Highly effective. That is the Baby Hug Moat. It's the largest national brand in that 0 to 4 category. And crucially, FirstCry refuses to sell Baby Hug on Amazon or Flipkart or anywhere else.
So it's a walled garden.
It's a classic walled garden strategy. Apple does it. Nike does it. If you want the real deal, you have to come to us.
But the question is, how long does that fear last? For a newborn, absolutely. You
Right.
boil the bottles, you only buy the organic cotton, you sanitize everything.
You're terrified of doing something wrong.
But for a 4-year-old,
Yeah, by the time they're 4, they're eating dirt in the backyard. The fear has subsided.
exactly. As the kid gets older, safety becomes less of a selling point than price and durability.
Okay.
Parents relax. And that's exactly where Zudio strikes.
So Zudio wins on the playground while FirstCry wins in the maternity ward.
That seems to be the split. But Zudio is aggressively expanding its kids section.
Yeah.
They want the playground and the nursery, and Reliance Trends is doing the same thing. They smell blood in the water.
They do.
Okay, so we've discussed the external enemies. They're coming from all sides. Quick commerce attacking the essentials, these fashion giants attacking the clothes. But usually when a stock drops 50%, there are internal demons too.
Almost always.
Let's look inside the house.
The internal health check.
Yeah.
This is where the financial statements get really interesting and honestly, a bit concerning.
There's a paper problem that really stood out to me in the reports. Employee benefit expenses.
Yeah.
They rose 23.26% year over year,
Right. And now remember what we said revenue grew at.
about 10%.
That is a mismatch you never, ever want to see. Your costs are growing more than twice as fast as your sales. That is fundamentally unsustainable.
And a huge chunk of this is ESOP's employee stock ownership plans.
Right. Now, companies love to say, oh, ESOPs are a non-cash expense.
It's not real money, it's just stock options.
Yeah.
It doesn't affect your bank balance.
Exactly. They say, look at our adjusted EBITDA, ignore the ESOPs. But as an investor, you absolutely cannot ignore them.
Why not? Could you explain that for us? Why should the average listener care if the employees are getting stock?
Because it's dilution. Think of the company as a pizza. You, the shareholder, own a slice of that pizza. When the company issues ESOPs, they're essentially just creating new slices out of thin air to hand out to employees.
So the pizza stays the same size, but my slice gets smaller.
Precisely. Your percentage of ownership in the company gets smaller. So even if cash isn't leaving the bank account today, the value of your share is being watered down over time.
And it also says something else, doesn't it?
It does. High ESOP costs imply the company is betting heavily on human capital hiring, very expensive talent, expensive engineers, expensive managers, that hasn't actually yielded a return yet. They are paying for growth they haven't achieved.
And then there was the cash flow red flag.
This one honestly shocked me. FirstCry has a revenue scale of nearly 8,000 crore rupees.
That is a massive business.
It's huge. But their operating cash flow in FY25 was negative 83.45 crores.
Let's just translate that. Operating cash flow is the cash generated by the actual business selling stuff minus the cost of buying that stuff and running the store.
Correct. It's the lifeblood of a company. And it means their core business is consuming cash, not generating it.
So if they're selling 8,000 crore worth of stuff, where is all the money going?
Well, marketing is a huge black hole. Customer acquisition cost CAC are very high because of that churn, that leaky bucket we talked about. They constantly have to spend to find new parents.
Right.
Logistics is extremely expensive. They rely heavily on express fees for delivery, which is a related party, by the way, which is a whole other conversation. And just maintaining those 1,000 plus physical stores is not cheap.
Rent, electricity, staff salaries, inventory holding costs.
It all adds up. It's the burden of being an omni-channel giant. You have the high costs of a tech company, the engineers, the app development, and you have the high costs of a traditional brick-and-mortar retailer, the rent, the store managers. You're basically paying double.
And with a return on assets, an ROA, of just roughly 1%, they are running on razor-thin efficiency.
It's very low. They have zero debt, which is great. They aren't going to go bankrupt tomorrow from interest payments, but they aren't sweating the assets they have. It's a sign of capital inefficiency.
Speaking of sweating assets, let's talk about their big subsidiary, Global Bees. This is supposed to be their rocket ship, right? The Thrasio model for India.
The House of Brands concept. It was all the rage back in 2021. The idea was simple and on paper quite brilliant.
Which was?
Buy up dozens of small, promising D2C direct-to-consumer brands that sell on Amazon. You know, brands selling bamboo toothbrushes or niche supplements or whatever. Then you plug them into the massive FirstCry supply chain and marketing machine and you scale them to the moon.
But the rocket ship seems to be leaking fuel. We had some very high-profile exits. The CEO of Global Bees, Nitin Agarwal, resigned.
That is a major, major signal. When the captain leaves the ship, you have to ask why. He was replaced by Anuj Jain, who is an internal FirstCry veteran, but it's not just the CEO. There were reports of investor directors leaving the board too.
No, the management says nothing to see here. The official line is that the directors left because they were rotating out or moving to observer roles after a new funding round.
The official narrative. There's always an official narrative.
Right, but there's a signal in the noise. The strategy is clearly shifting. It used to be acquire everything. Now the new buzzword is rationalization. Which
is just corporate speak for we bought some bad companies and we need to clean up the mess.
Right.
They are pruning the portfolio. They are looking at these, 50 plus brands they bought and realizing, wait a minute, half of these aren't actually scalable. They're getting rid of the long tail of brands that aren't working and trying to focus on a few core winners.
And there was one specific controversy that I think highlights the struggle here. The case of the Merhaki founder, Ankur Goyal.
Yes, this was buried deep in the legal disclosures of their IPO documents. He resigned without notice, and the company alleged he violated his employment agreement.
That sounds like a really messy divorce.
It is, but it hints at a deeper culture clash. You take these scrappy, independent founders who are used to running their own show, making decisions on the fly, and you try to fit them into a big corporate structure like Global Bees with reporting lines and budgets and HR policies.
It doesn't always work.
The entrepreneurial spirit often clashes violently with corporate governance. It's a very difficult integration process.
So Global Bees is in the middle of a big, painful shuffle. They're trying to turn it from a collection of startups into a single, profitable division.
And until they do, it's a drag on the bottom line. It's weighing down the main FirstCry stock. Investors look at it and see uncertainty.
Okay, so let's just recap the gloom for a second. India's growth is slowing down. Competition from quick commerce and Zudio is heating up and attacking them from both sides. Internal costs are rising faster than sales. Is there any good news? Is there a light at the end of this tunnel?
Well, there is an oasis. Let's talk about Saudi Arabia.
The KSA bet. This is fascinating. FirstCry is expanding heavily into the UAE and Saudi Arabia.
Why?
Why there? Why not, say, Southeast Asia? Why not try to crack Europe?
Think about the demographics. It is almost perfectly tailored for a brand like FirstCry.
Also,
you have very high disposable income, very high. You have high birth rates, much higher than the West or even parts of urban India. And you have a market that is still very fragmented.
So you have rich parents having lots of kids And no dominant player like Amazon or Zudio to fight against yet.
Theoretically, yes. It's the perfect playground for them to establish dominance.
But it hasn't been cheap to get in the door. The sources say KSA is in year 3 of operations, and it's still loss-making.
It always is at the start. It takes time and a lot of money to build a supply chain and brand awareness in a new country. But the trend line is what investors are clinging to.
And that trend is positive.
Very. Losses were reduced by 52% year over year in Q2. That is a massive improvement. It shows they're getting a handle on the business.
That is significant, and they just launched a new flagship store in Riyadh.
And the strategy is different. They've learned from their experience in India. They aren't just copy-pasting the Indian playbook.
What are they doing differently?
They're being much smarter about the top-line mix. In India, they started with diapers, the low-margin stuff, to get customers in the door. In KSA, they're trying to push the high-margin fashion and private labels much earlier in the customer journey.
Because the Saudi customer has the wallet for it. They don't need the discount diaper to be lured in.
Exactly. They are trying to bypass the commodities trap that they fell into in India. However, the one big challenge is CAC customer acquisition cost.
It's expensive to find customers there.
Incredibly expensive. Marketing in the Middle East, influencers, digital ads on platforms like Snapchat and Instagram, it costs an absolute fortune.
So you have to spend a lot of money to find the customer. But the hope is that once you find them, they'll spend 10 times more than an Indian customer.
That's the bet. Management believes KSA will hit profitability faster than the India business historically did. If they can crack the logistics and keep that CAC under control, this could be the engine that drives the next phase of growth for the entire company.
It's a very high-stakes bet. If India is the fortress under siege, KSA is the new territory they're trying to conquer to save the empire.
That is a very, very apt analogy.
So we've covered the battleground. Let's try to summarize this entire multi-front war for our listeners.
It's a complex picture. On the commodity front, you've got quick commerce, which is faster and is stealing that daily frequency.
Right. Blinkit and Zepto are winning the diaper run.
Then on the fashion front, you have Zudio and Reliance Trends, who are cheaper and have massive, massive physical scale.
They are winning the playground fashion show.
And internally, FirstCry is fighting its own bloat, the rising ESOP costs, and the ongoing global bees integration struggles.
So let's step back and look at the investment thesis.
Yeah.
With all this going on, what is the bull case? Why would someone buy this stock today?
The bull case, in one word, is mindshare. FirstCry owns parenting in India. No one else has the content community, the advice forums, the hospital network.
Oh, the hospital network is huge. They deliver FirstCry boxes to new mothers in thousands of hospitals.
Exactly. And that builds a trust factor from day one that is incredibly hard for a competitor to replicate. When you have a baby, you trust FirstCry. You don't trust Amazon in the same emotional way for your newborn.
That trust is a powerful, intangible asset. You can't just buy that with venture capital.
You can't. And they have over 1,000 specialist stores. That is a physical moat that is very expensive and time-consuming to dig. If they can figure out how to monetize that trust better, maybe through services, maybe through education, maybe by making the KSA expansion work, then they win.
And the bear case?
The bear case is simply valuation. Even after a 50% drop, they are trading at a massive premium, a 167x PE ratio, in a market that is structurally slowing down and facing hyper-competition.
It's priced for a future that might not arrive.
If growth stays at 10-12%, the stock still has a long way to fall to match reality. It's the difference between being priced as a tech disruptor and being priced as a retailer. Retailers don't get 160 PE ratios.
They definitely do not. They get 30, maybe 40 if they're very, very lucky.
Right.
This brings me to a final thought, something I was mulling over while reading all the source material, specifically about the age brackets and their desire to grow with the child.
Go on.
So FirstCry says their future growth depends on expanding their target base from 0 to 4 years to 0 to 10 years and beyond. They want to keep the customer longer.
Correct. That increases lifetime value. It's the holy grail.
But think about the name, FirstCry. It is literally completely synonymous with infants. It evokes diapers, crying, pacifiers, all of that.
It's a very specific brand association. It absolutely screams baby.
So my question is this. Can a brand named FirstCry ever really be cool enough to convince a 10-year-old boy to wear their clothes?
That is a fascinating branding challenge, a huge one.
Imagine a 10-year-old at school. Kids are brutal. Hey, cool shirt. Where'd you get it? Oh, I got it at FirstCry.
Yeah, I see your point. The social currency just might not be there. You don't want to be wearing clothes from the baby store when you're trying to be a cool preteen.
Exactly. Does the very strength of their brand, that intense emotional connection to the newborn phase, actually become their ceiling as the child grows up? Zudio doesn't have that baggage. Reliance Trends doesn't have that baggage. They are just fashion brands.
It's the Gerber baby problem. You trust Gerber implicitly for baby food, but you would never, ever buy a Gerber-branded steak for dinner.
Perfectly said. FirstCry might be the Gerber of Indian retail. And breaking out of that box, convincing a 10-year-old that FirstCry is cool, that might be their hardest battle yet.
It will require more than just financial engineering or better logistics. It will require fundamental brand evolution.
Well, that is a lot to think about. Whether you're an investor looking at the charts or just a parent deciding where to buy that next set of onesies, the FirstCry story is one to watch. It's a battle between legacy trust and modern speed.
Knowledge is power, but only if you know what to do with it.
Couldn't have said it better myself. Thanks for listening to this deep dive. Don't forget to subscribe so you don't miss the next one. We'll see you then.